Right, let's talk about some cars. Top car is easy to drive, pretty practical, but pretty boring actually. Bottom car requires teamwork, it requires long-term investment, it requires specialist knowledge, but can deliver exceptional and brilliant returns or brilliant performance. Why do I mention this? Well, over the next 20-25 minutes, I want to run you through why I think that outlets far better represent the Formula One car than the Ford Focus. That's not to say they're not without risk, and hence the Formula One car. Giving you the history, if you go back, it's quite timely actually, it's a nice 10-year period, you can see where we've come from over the last 10 years. We've come from almost being an alternative sector through to being institutionally accepted. Critically here, you can see obviously generally the stability you'll have seen through the outlet market. Of course, during this downturn and obviously the global financial crash, you can see almost a flat yield profile here. Interestingly though, with values, the values generally with the best outlets either at very worst stayed flat or grew, because clearly even with the yields going up, the income was going up. Now the yields have come down dramatically, particularly 2015 is actually over here there weren't many buyers, almost nothing there. Suddenly you get new entrants coming in, and we think very much that the yields are pushing down very, very tightly now. What I should say though is that between here and here, you've also had the emergence of what we would describe as the super prime. 10 years ago, arguably, there was only one real super prime, which was Bicester. I think now we've definitely got 5 to 6 super prime centres. However, the market is very small. So, depending on how you look at your figures, you can actually get up to a floor space of about 6% of shopping centres if you count everything that is technically outlet. However, if you strip out what is actually things like, as you came in, you'd have seen there's a building on its own standing there marked outlet. If you strip that sort of product out, you get down to almost only about 2%, so 3 to 3.5 million of floor space compared to shopping centres. But, as Timon said, there's generally, we would regard about 250 outlets throughout Europe, of which probably only 50 to 60 are the real decent top-end ones. There's an awful lot of, should we say, more tertiary and secondary. So what makes an outlet different? Apart from the actual retailing itself, it's very much about the lease structure. You generally, and it is generally, there is a structure which gives you a base rent with a turnover top-up. That base rent has got annual reviews on it, which are either indexation or a ratchet of the previous year. And clearly then you can then get up and keep growing your income up. Now, obviously we've used the analogy here of froth. We shouldn't put that down as a risky froth. If an outlet is working, it's either going upwards. If it's not working, it's going downwards. So you have to come away from the fact that actually you've got base and turnover. To us, it's all income. It might be a small market, but you do get some phenomenal returns. Now, it was quite a nice slide with the 11% on it. This is for the period of 2016. On the left is shopping centres across Europe. On the right is outlets, and that's got a sample size of about 60 on it. You can see quite clearly, here's the sales growth coming through. Now, critically, if you take the numbers of, say, 11% sales growth, it's coming through to 9% of rental growth. If you looked at that on a standard shopping centres, you'd be very, very pleased to get that. But it's swayed slightly last year by actually some extensions, so hence actually like-for-like sales were up about 6.5%, total sales up about 11%. So clearly with returns like that, we are seeing massive, massive demand for the sector. But it is, as we keep coming back to, a very small sector. So you'll see, again, back to 2008, you saw a bit of activity, and actually this was the tail end of some purchasing by the European Outlet Mal Fund, then a quiet few years, and then actually this is the years where we start to see much more of the activity come back through. This year is swayed by the purchase or the split up of the Irish portfolio. Now, looking actually at the quality of the outlet, there is a real broad range here. And there's a few things to be aware of. there is an awful lot at this level here, which are those that are trying to be outlets that actually are really discount shopping centres. They have got the outlet lease, but if you're selling outlet product, also selling high street product at a discount to the high street, you're competing with the high street. If you're up in this level where you've got many more, you've got tourism income, you've got much better brand lineup, you're very much your own destination, so you're selling to a very different consumer and you're able to then drive forward. You can then see, if you come through here, actually the type of investors you'll get. At the bottom level, you're very much looking at the opportunistic guys. Then you start to get towards the institutional guys. Now, at that sort of good secondary level, you will get the standard institutionals coming in. So the Avivas, the Henson, Huckput, etc. Because to them, it's quite clean. It drives through. But once you get above this, where they start to get into the real sort of prime and super prime, this is where the asset moves from being a property asset to being what we would just term as a property-backed business. It's very much about driving the business rather than a simple landlord and tenant relationship. Clearly, also, the lot sizes here are going to get much more sizable. Now, I was being slightly careful with the sort of densities on there, but thank you, Timon, for putting a bit more accurate one on there. Now, I mentioned earlier about the specialist knowledge. If we think of, say, 250 outlets, this number, there's 89 here. Actually, the ones that you really want to be looking at are conveniently this pack here. Generally, these are secondary. Realm ones are pretty secondary, and as you can see, they tail off down towards the secondary and tertiary. Now, you've got the VIA and the value retail portfolios, and as Timon said, you've got sort of the prime, super prime, and those with the turnaround stories. You've got the name of the schemes, which are a mix of prime, sort of poor prime, good secondary. Then you've also got the MacArthur Glen schemes. Now, I think the thing that does sort of sway this chart is actually it looks like MacArthur Glen have got a massive lead here. If you come back to the ownership structures, though, MacArthur Glen have got multiple ownerships in this. And so when I say multiple ownerships, that's not stakes within MacArthur Glen or stakes within centres. That's different properties owned by different people. Clearly, the benefit of these schemes is that you've got one sort of set of group of investors working together for the common goal. But critically, there is still over 100 more. Now, there are a couple on there that are what we would, one more that we would term as super prime, which sits outside, but those that are super prime generally sit within that group. But why is the specialist knowledge needed? Well, this is just one example of the cost that goes into an outlet. I think it's fair to say that when you talk to new bidders coming into the market, everybody's very keen to get into the market. But once you start to take them through the detail, there's often a bit of a shock about actually how much these things cost to run. That's not a bad thing, because obviously, as you saw earlier, if you put money in, you can get it back through the income. But just taking probably arguably the most risky part of the investment, which would be the marketing budgets, and I'm sure the marketeers will tell you 50% of the budget hits and they're not sure which 50%, but you can quite clearly see that the marketing budgets fly up. Now, some of this, of course, is recoverable from the tenant. Some of it you'll decide as a landlord, commercially, you won't wish to recover. But if you drive the sales, if you drive the footfall, then you can get it back through your rent. But coming back to why you need to spend the money, if you take, say, a prime shopping centre, we use the example Bluewater, 25 million people, Westfield Stratford, 40 million people, the best outlets, generally their footfall levels get up to about 7.5, 8.5 million people. But what they are doing is converting every single shopper. What you're not getting, as some of the outlet managers unpolitely refer to it, is the P&T stops. So you're not getting people popping in there, picking up a couple of things. People, when they go shopping in outlets, are going shopping to spend money. But clearly, if you come in as a sort of an individual person or an individual owner and try and do that, you're not going to have the benefit of, one, economies of scale, but two, the knowledge of actually where you should be targeting. Now, I mentioned earlier also about long-term costs. Bearing in mind that actually, if you look back at your tourism-driven outlet, if you spend money today, it may not come through into your value, so first of all, rent in year 1, 2, it may be 3 years off. Bearing in mind, if you go back to, say, the Bicester example, you might be spending money on Chinese tourism that will come through 3-4 years down the line. That's not to say you shouldn't do it, that you should definitely do it. It's about driving the asset over a longer period. Now, funny enough, this slide actually keeps looking like we're going to keep changing it around. There is a core investor group within the outlet market, and actually they're pretty much tied up together as well. So Namer and THRE have formed a new JV called Neptune. You've got APG and Hammerson, who you've got in the room here, and you've got an investment with McArthur Glen and Simon, and then you've got Aviva, who are invested with partly with McArthur Glen. Every so often we think we're going to get a surge of new money coming into the sector, and to some extent we have had it. We've had a couple of recent sales where new money has come in. What has happened is that they have, one, taken an awful long time to complete the deal, but two, they have actually at least driven some pricing, so put some evidence, but evidence generally at that more secondary level. Certainly there isn't the trading going on in the prime things, certainly not on a overall asset basis. But actually what that's allowed those who are within the sector to do is then consolidate, because then of course they can then go back to their boards and prove that actually that's where the market is, and then further grow their investment. The problem that the new players are coming in, and partly the reason for the time delay, is not just understanding the asset, it's then finding the right partner. There's quickly a realization for the new players that actually they do need one of the big three to operate the schemes. So how do you get more exposure to the market? Well, it's a limited market. There isn't a lot of supply, so actually most of it has come through extensions. Interestingly, out of the 10 recent extensions, either coming shortly in blue or just opened in red, 5 of those have been extensions and the rest have been brand new MAUs. What we are seeing is actually outlets are getting bigger. I think it's fair to say if you asked us 5 years ago, you would have said that the average, sort of an optimum size of an outlet for certainly a super prime outlet and a prime outlet would be probably about 25,000 square metres. It's now getting up towards 30, and certainly some of the really big schemes are now heading towards 45. So coming back to this point about the platform being key, these are actually all the recent sales over the last 2 years. It looks like a lot, but actually, if you can just about tell, and probably better in this pack here by the colours, they're generally either split up portfolios or sort of going into portfolios. And actually, of those that are not going into portfolios or coming out of portfolios, the blue ones, with the exception of Wolfsburg and Festival Park, the others are going into McArthur Glen, and Festival Park clearly went into VIA. So actually, with the exception of Wolfsburg, everything went into portfolios of operating platforms. We wait to see, well, we know what's going to happen, but the Peakside portfolio that we've just completed on, that will go to be one of the non-core, of the core outlet operators, but it won't be a mainstream one. But again, clearly somebody trying to build a platform here. What I expect to happen in the long term is actually those who have tried to build platforms will in the end come back through to the core group. Now, coming back to this point about very limited supply, given we've got 250 schemes, and this is a map of all of Europe, that is actually the only things that are openly on the market. And without doing my investment colleagues down, we've had this one on the market for a while. We've had this on for a little while, and we've bought that, and that will probably go fairly well. These two are really struggling, and there's quite a lot of interest in the Norwegian outlet. But actually, there isn't the demand of stock. So actually, if you wish to get at the table, to get sort of almost like the race seat you want for the Formula 1 car, you've got to sort of go in with the long-term relationship and build up from there, and then get the opportunity to buy them, hopefully off market. Because coming back to this, if it allows me to go back that way, actually what we haven't seen is any really large portfolios being traded in the open market. The IRIS was split up between parties, but it wasn't traded openly. If you brought a large portfolio to the market, there would, at the moment, with the demand there is, be a certain portfolio premium, and it could be very substantial. But clearly, those who are within the market don't wish to release into the market because you want to build up your exposure. Running just briefly through actually the recent sales, you'll see here 2 of these are for the IRIS fund breakup, some going to VIA, some going to Neptune. I have to mention, despite being in a presentation for Hamilton's investors, Land Securities buying these. But I think it's, again, coming back to this point, you have to buy something and build it up from there. In summary, they are complicated assets. They do require a lot of effort, but they do give phenomenal returns. But clearly, you just cannot go in and just expect to be able to drive a Formula One car, or in this case, an outlet. Got some time for some questions. Yep.
Can you give us a bit more of an outline on planning? I think there's this theory that planning is quite restrictive, but it's in different countries which have different planning. So
Absolutely. The most extreme countries actually generally are the UK, but Germany. Germany, you get even to a point where the neighbouring towns will object to you even after building. So I think even if you come back out of Germany and to France, most outlet schemes take at least from scratch. The best case scenario is 3 to 4 years. We've known of schemes that have taken 7 years to get out of the ground, because it takes that long to get through the planning. It is often there is still very much a perceived concern that they will attack the high street, and to some extent, if you go back to the German example, this is concern from neighbouring towns, and particularly with the federal system, but actually that town's going to do better than the other because it's suddenly got the draw in. Bearing in mind that when the opening of Batavia happened here, the mayor is very much behind the scheme because it brings people into Lelystad and actually drives the region in general, and it isn't deteriorating for the town, but there is still that perception that does it compete with the high street or not.
Are there a couple of questions from me? Good afternoon. A couple of questions. First off, can you give some indication of what the sort of structural size of this market could be? I'm thinking at the top end specifically, which I guess is most relevant. Presumably a company like Gucci or equivalent don't want 100 discount stores across Europe. They have a number in mind, and we can't have, therefore, 100 super prime outlet centres. And I guess the second question, which is presumably related, I'm looking at the sales growth and the yield shift over the last 10 years. It doesn't look like it wasn't a mature market 10 years ago. It probably still isn't mature today. At what point could it become mature, and what sort of statistics would go along with that?
Okay. In terms of how much can the market grow, I think if you come back to looking first of all at the super prime and the prime ones, there is still a few holes around Europe, but it is a few holes around Europe. I think I always come back to the UK. The UK has 30, 40 odd outlets. Actually, you only really want to think about the top 8. What we will find within Europe is there's potential to knock out a few more challenging schemes. But you're right, if you go back to being the really top end ones, the luxury brands, and Value Retail can tell us in more detail, but the luxury brands only require certain stores, and they are to some extent quite fickle in terms of you do get the Prada Group probably every 2 years changing their strategy, saying we do not want outlet or we don't want outlet, due to the perception on and who's running the business at the time. I think the market can probably, we're at 250 outlets now, we can probably squeeze up to 300, but I think in terms of super prime, probably we've got space for up to about 10, and prime, you're probably at about the capacity now, albeit you can probably drag a few of the more good secondaries up, so you probably will get up to about 70. Now, just remind me of your second question.
And just the maturity of the market and where it could go.
I think it's fair to say, I was discussing with somebody earlier about where do we think the long-term growth is. It's very different when you're modelling these things. Clearly, obviously, the default answer is that these things should stabilise out at 3%. It's clear when you talk to Value Retail, McArthur Glen, etc., there is still scope to grow these outlets at probably another 5% for some time yet. In terms of how it gets from being alternative to being completely and utterly institutionalised, I think that's probably going to take more of a switch in the main sector, because ironically I do think and believe there's probably a disconnect here between market value or price paid and worth. Clearly, if you're getting growth returns as you are here, you should be paying better than super prime shopping centres. However, we come back to this point about those who are within the market wish to be within the market and wish to take advantage of that worth, but don't wish to drive the pricing on too much further, the new entrants, well, they will do when they want to sell, but the new entrants coming in, clearly the first thing they see is, oh, that's a lot of money, you're spending a lot of money on this, this and this, why? And it's almost a lack of understanding. Once we start to break through that, and I do think that it will probably take a bit of a switch, and it is occurring that actually the investment market generally for property, we are seeing much more focus on the alternatives, much more focus on those businesses or properties where you can drive the business itself, where you get a direct relationship with the tenant or the consumer that way through. But you're probably still talking 5 years off yet. Go on. Yep. Oh, sorry.
Sorry, just following on from that then, if you're saying these should be priced better than super prime shopping centres, your outlet yields on page 2, are they deducting for the higher operating costs?
Yes, they are.
So it's fully net out?
Yeah. So, John, come back.
Just want to ask on the rent, the lease structure.
Yeah.
You talk about a base rent. Is that? Can you just explain the sort of gearing to sales? Are we effectively 1 times geared to sales growth? That's to say, is it a minimum rent, or is it a true base rent, and the top up is 1 times geared to sales growth, or can you just clarify a little bit?
Yeah. So when the operators look to set a rent, we tend to work, and they'll be working on their own percentages, but the rule of thumb, you'd look for a base rent of 10% of what you expect the sales to be. Now, if you're bringing a tenant into a centre like this, you would look to at least put somebody in at average, if not better, because, of course, you don't want to draw the density down, because the density is twofold. The density, of course, is easy for you then to play it back to the next brand, but clearly you want to continue to drive the sales because everything comes up. But what you'll probably find is that generally the turnover percentages are anywhere, depending on the quality of the asset, between 8 to 15%. Generally, for better centres, you ought to be looking about 12 to 15% now.
So effectively, you are, as near as damn it, 1 times geared to sales growth.
Yeah.
Okay, thank you.
I just have a question on yields, and maybe this is one for Hammerson, but could you guys give us a sense of the range of yields in your portfolio, maybe how they differ between what you described as A plus and the BB plus centres?
Well, Richard is the banker, so Richard, why don't you go to the chart?
Yep.
Which looks at the range of projects.
Your
No, I was thinking, go to the one.
Yeah, I mean, this is quite accurate, eh? I mean, this is saying you got 4.75.
Yeah.
But I think we've got from there to about there in our 19 villages. And I think our average is about there.
Yeah, if you look at the buy-in on the Iris portfolio, I think you reported 5.5%, which gives you the sort of the ranging on that. You'd expect the better ones to be trailing, attacking quite closely towards the super prime shopping centres within those countries, albeit a bit of a margin above. Okay.
Just sticking with the yield point for 1 second, Timon, on your portfolio, are they valued on a triple net basis? Coming back to Mike's question, just thinking about the comparability when we're looking across the yield profile of the rest of your portfolio.
When you say triple net, Robbie, you mean deducting for...
So NOI basis, or are we talking GRI?
Yes.
So I'll just be clear, on an NOI basis?
Yes.
Thank you.
Maybe one more question.
Yep.
And just the portfolio premium question you're suggesting for somebody like Hammerson, that would be warranted. There's nothing in the valuation for portfolio premium at the moment?
No. And we're required to report individual values.
And what do you think it would be if somebody was to buy
it? With the agency, Hal, I think when we looked at a portfolio, if you're getting up towards 10 outlets, assuming they're all decent quality and you're not trying to hide some dogs in there, it's quite conceivable you get 10 to 15% on top.
I'm confused about this comment that these yields are NOI based, because when I look at your numbers,
your running yield is way lower than 5.5 or whatever it is.
Yeah.
So there are costs that are
Yeah.
flowing through the business that are not in those yields, I guess, or
Yeah.
what's the difference?
So what Sven is saying is if you look at the disclosure, for example, of value retail, it's a bit early for VIA yet because we haven't expanded, you will see a lot more costs in there, and that's because there is quite a lot of G&A. So it's the G&A costs that we are absorbing in our share of value retail, or indeed the 100%. It's a bit like the G&A for me. You know, I don't really do any work. I just kind of float around. I know we've had this conversation, Sven. So the way that the appraiser will look at it, whether it's Cushman and Wakefield or CBRE or anybody else, they will look at excluding the G&A.
Yeah, I think the critical thing when we're looking at these is we have to come back also to what the market would do. And it's fair to say value retail are an exceptional operator. MacArthur Glen are very good too. But also we have to look at the long term here. How would you price this up? Clearly, if you take a VIA scheme, on the very first day of purchase, we're not going to look at VIA's budgets because actually their intention is to completely change that asset round and move it on. But if you were to sell it the next day, what would you do? You'd base it upon the most clean NOI position, most healthy NOI position. And clearly, as these things evolve, you can then start to sell them with a 3-year sales package.
Yeah, but that means that these yields are not like for like. I mean, you can't compare a shopping center yield like there with the outlet yields because the G&A load will be much higher for the outlets.
No, I'm talking about overhead costs. I'm not talking about G&A within the centre.
But yeah. Yeah, okay, but you're running a business, so...
Yes, I suppose the difference then is the growth rates. So it's coming back to the relative growth rates, Sven. So you might get an NOI growth rate of somewhere between 5 and 10%. That's hard to do in full-price shopping centres. So it's a trade-off. Yeah. But, the total return is still pretty attractive, which is one of the points we're trying to get over.